Think about the last time you sent a huge file, saved an important note, joined an online event, or watched a creator's video. You probably cared about one thing. Does the app just work when you need it? Bending Spoons is betting that those familiar apps can be bought, rebuilt, and run better. This IPO preview from the Cursor Stocks is about Bending Spoons, ticker BSP, an Italian company most people don't know by name but may know through the apps it owns. The central question is simple. Is this a real operating machine already, or a big bet on what all those old internet brands could become? The company is led by CEO Luca Ferrari, based in Milan, and founded in 2015. Its story is unusual because it didn't become famous by launching one giant consumer app. It became known for buying apps people already use, then changing the product, the pricing, and the team behind it. The easiest way to understand Bending Spoons is to stay with that file you sent. The company doesn't own the internet, and it doesn't make your laptop. It owns digital products like WeTransfer, Evernote, Vimeo, Meetup, Eventbrite, AOL, StreamYard, Brightcove, Komoot, and Remini, then tries to squeeze more value out of them. That matters because many older apps have something startups would love to have. People already know them. The hard part is making those people pay, stay, and use the product more often. Bending Spoons pitches that its teams and internal software can improve these products faster than the old owners could. The money engine is not mysterious. Buy a product with users, improve it, adjust pricing, cut wasted costs, and keep the cash flow instead of flipping it quickly. If your file transfer app becomes more useful, more reliable, or more worth paying for, a tiny piece of that monthly payment flows back to Bending Spoons. Now the company wants to go public, which means selling tiny ownership pieces, called shares, on the stock market. It is set to list on NASDAQ on July 1, 2026, under BSP. The planned range is $26 to $28 per share, with about 58 million shares offered. Because the deal amount and share count line up at the top of the range, Bending Spoons is expected to price around $28 a share if the deal holds. That would raise about $1.62 billion. For a new investor, the important idea is that an IPO brings fresh attention, fresh money, and public market pressure all at once. The scale is what grabs attention. The company says its products reach more than 1 billion registered users, more than 400 million monthly active users, and more than 7 million monthly paying customers. That's the bull case in one sentence. These are not tiny experiments. These are apps with big existing audiences. But here's where the story gets more interesting. Bending Spoons says it doesn't just buy a brand and leave it alone. It points to product updates after acquisitions, like hundreds of Evernote improvements, dozens at Komoot and StreamYard, and new AI features for Vimeo. The bet is that better products can support better economics. So what would have to be true for this IPO to make sense? First, users need to stay even after pricing or product changes. If people love the old version of an app and hate the new one, the whole machine slows down. For Bending Spoons, trust is not a soft issue. It's part of the revenue engine. Second, the company needs to keep finding apps worth buying. There are only so many well-known digital products that are tired, undermanaged, and available at a price Bending Spoons likes. The dream is a repeatable playbook. The catch is that every acquisition brings a different customer base, code base, culture, and set of headaches. Go back to WeTransfer for a second. The company says it recovered more than 3 million expired transfers and saved more than 100 user time years through reduced upload times. That sounds small next to a billion-dollar IPO, but it shows the basic idea. Make a familiar product less annoying, then hope users reward that work. The bear case starts with the same facts as the bull case. Bending Spoons often changes companies deeply after buying them, and according to reporting, that has included major layoffs at several acquired brands. Investors may like lower costs. Users and employees may see disruption. The question is whether the products get stronger, not just leaner. Financially, this is not a tiny app shop. In its latest full year, Bending Spoons brought in about $1.31 billion of revenue, which is the money coming in before expenses. Profit is what's left after the bills are paid, and the company was basically near break-even, with a small net loss of about $137,000. Competition is messy here because Bending Spoons doesn't fight one enemy. Each product has its own battlefield: file sharing, notes, video hosting, events, communities, email, and creator tools. That means the company isn't making one simple wager. It's managing a shelf of different apps, each trying to keep its own users from drifting away. The valuation tension is unusually important because a final IPO valuation hasn't been set yet. So don't let a missing price tag make the story feel fuzzy. The planned raise alone, about $1.62 billion, is bigger than last year's revenue. That means public investors are being asked to fund a very ambitious next chapter. One detail to watch is who gets the IPO money. If most shares are newly issued by the company, the cash can help fund acquisitions and operations. If existing holders sell a lot, more money goes to early owners. Also watch the lockup, the waiting period when insiders usually can't sell right away. After it lists, don't try to follow every headline. Watch 3 simple signals. Are paying customers growing? Are profits improving without damaging the products? And does Bending Spoons keep buying useful brands at prices that still make sense? Those 3 questions tell you more than a noisy first-day stock move. So the balanced view is this: Bending Spoons owns real products, with real users, real revenue, and a clear strategy. The doubt is whether that strategy keeps working at public company scale, where every acquisition, layoff, price change, and product complaint becomes part of the stock story. This is the part investors will argue about. Bring it back to that file you sent. If the app works better, users may stay, pay, and make the whole strategy look smart. If it gets worse, the brand name alone won't save it. Follow the cursor stocks, and the next IPO story won't feel so confusing. This video is for information and education only, not financial advice.